Hey guys, what's up? Welcome back to The Impeccable Investor. If you want to invest your money and maximize the returns on it, then buying a cheap dividend stock is the best option you can ask for. You can earn a handsome dividend while taking benefit of the rising stock value. And you know what they say, the cheaper and riskier the stock is the more reward it offers. Here are the 5 of the best and cheapest dividend stocks that you can get on the market. Number 5, Centurylink. The first stock on our list offers a whopping 10.5% yield currently. Having faced a dividend cut 2 years ago, the U.S. telecom company is now giving out a 25%. Having faced a dividend cut 2 years ago, the U.S. telecom company is giving out a 25-cent per share dividend on a quarterly basis. Due to the current ongoing pandemic situation, Centurylink's stock has suffered a bit of an incentive as it's seen as essential infrastructure by its customers and business community alike. However, the company runs the long-term risk of its operations not being robust enough to invest in upgrading its network to the next-generation technology of 5G or locating massive growth opportunities. But for the time being, if you are interested in buying a cheap stock that offers you a double-digit yield, Centurylink is definitely worth a shot. Number 4, Intel. Next on our list is the American multinational corporation Intel. The company gives a 2.2% yield, which is better than the S&P 500 average. It's a great opportunity to add an amazing tech stock to your portfolio that also lets you earn a dividend. This networking, storage, and computer giant is still rather in a good place in the global pandemic. As more and more businesses move to cloud-based networking, the demand for Intel's computers, processors, and cloud technology is more than likely to stay strong. On April 23rd, when the company's first quarter results for 2020 were released, they demonstrated that sales had gone up by a total of 23%, which is very impressive. So it doesn't come as a surprise that Intel has been making some profits. Each of the last 4 quarters have seen a profit margin of 25% or above. Despite all this, the dividend isn't all that high, but it offers good growth and has only gone down less than 1% this year. With the price-to-earnings ratio of 11, Intel is a bargain dividend for the price and will surely help to diversify your portfolio. Number 3, Antero Midstream Corporation. With the uncertain conditions that we are all facing globally, energy prices have been quite volatile and linked stocks have been performing rather poorly. Antero Midstream Corporation is a company that focuses on storage and transportation besides owning and operating natural gas collection pipelines, compression stations, and processing facilities. Though there are some concerns that future dividends will probably not be as high as they are at the moment, the stock currently gives a massive yield of 24.4%. So, even a little reduction in the payout will still ensure a healthy income potential. Number 2, Walgreens. Walgreens Boots Alliance has been a bit out of luck this year with its share price. It has gone down about 29% to date, which means it is doing much worse than what the S&P 500 index has managed to do so far. For dividend investors, though, this is not bad news. The company is a top-notch pharmacy retailer and they have done a commendable job of adapting to the circumstances that the COVID-19 pandemic has created. Walgreens launched their drive-thru on May 4th to make it easy for customers to order their items in advance and then pick up their purchases at any of the 7,300 locations across the country. Customers have the option to avoid going into the store, but that's not all. Walgreens also extended its drive-thru service for another cause. The company announced that it was making it easier and safer for people to take the test for the coronavirus by expanding its drive-thru testing locations in 49 U.S. states and also Puerto Rico. The real reason why Walgreens is a great fit for your portfolio is because they have been consistently reporting profit in each of the past 4 quarters, even during these tough times. Another reason the dividend stock is the real OG is that it has increased its payouts 44 years in a row. At the moment, it's paying a quarterly dividend yielding around 4.5% per year. That's over 2% higher than what you would earn from the average S&P 500 stock. With its PE ratio of lower than 11 and a PB multiple of 1.5, the Walgreens stock offers amazing value for money. Number 1, RentACenter. With a market value of $1.4 billion, RentACenter is a mega renter of various electronics, furniture, and other appliances. In the coronavirus pandemic restrictions, 75% of the company's 2,100 stores remained open, while the other 25% of the stores operated with a closed showroom. It's important to note here that RentACenter's earnings have actually managed to grow during the COVID-19 crisis. Comparing it with its main competitor, Aaron's that closed off all its stores before opening them back up until recently. Due to its operations, the company's earnings per share for the year are expected to hike up 25% higher, making it $2.28 per share in contrast of last year's $1.82 EPS. The stock also has a good 4.4% dividend yield, which is a promising sign of its future earnings prospects. Given the current situation, people are now more interested in renting instead of buying, which usually happens during recessionary periods as savings become more important. So, it's the best time to invest in this cheap dividend stock if you want to benefit from its future earnings. This brings us to the end of our video. I hope you guys enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.